Good morning, ladies and gentlemen. Well, today we'll be examining why term premium is negative and falling at the same time, and what the implications are for your investments and for trading. First of all, let's have a look at a definition of term premium and a longer term chart. First of all, term premium is defined as the compensation that an investor requires for bearing the risk that interest rates may change over the life of the bond. It's basically the premium that you require over buying a whole series of short-term bonds instead of buying a longer-term bond. So if term premium is falling, the certainty that you feel or that you think is there as to where yields are going to be over the life of the bond, i.e., a 10-year bond, is greater. What does that mean? That means that someone is buying duration or that the market needs duration. I'm not going to go into the reasons why the market at the moment feels that it needs to buy duration, because nobody can know that. Everybody can have an opinion, but so what? Opinions are to a penny. The fact remains that the term premium has been falling steadily since it got into positive territory back into the middle of last year, when the market was more or less in turmoil and people had less certainty about where inflation was going and therefore what the absolute level of interest rates would be. Ever since then, it's been falling, and if you actually have a look at what that looks superimposed on an equity chart, it very much matches the peaks and troughs of equities trading throughout that period, and also of interest rates. That basically means that bonds and equities are tied together because equities, after all, are long duration assets. So when the market doesn't need duration, like here, or is not buying duration, equities sell off, and in a period like this, equities rebound together with 30-year and 10-year bonds, which are longer duration assets. So basically, it's a measure of demand for duration at the moment. That's what you could say. As you can see, we are making new lows on the year, which is supportive of longer duration assets, and that means it's very difficult to stay short of long duration assets. And that means in this particular situation that the yield curve is unlikely to disinvert because the demand for long-term assets is great, while the Fed continues its, how shall we put it, fighting the inflation for longer and therefore holding interest rates at higher levels for a longer period of time. The market is basically disagreeing that interest rates will be held at these, let's call it extreme levels, for a long time. It just doesn't make sense that you would prefer to buy 10-year or 30-year bonds at these yields rather than just rolling over your short-term paper. And therefore, the market is betting that the Fed will hold interest rates at high levels for a shorter period of time than the current yield curve implies. So what does that imply for the yield curve? Well, it implies that the market is looking for this direction of trading, i.e. a disinversion at some stage. And it could be that the market is just looking at what has happened traditionally. So if we change that to a 1 month chart, you can see where we are. And therefore, what the market is saying is that the direction of travel is going to be this way, down towards these levels, around 50, something like that. Why? Because that is what has always happened in the past. Now, does the market know the speed of it or the timing of it? Well, obviously not. But the market is saying that the most probable direction of travel is going to be this at at some stage. Is that unreasonable? No, it's not unreasonable, because that's exactly what's always happened in the past. And that is probably why you are having this duration bid at the moment. However, that is really not supported in the very, very short term. This is 2's 10s, and to me the direction of travel over the next few days is more likely to be up towards 75 than a breakthrough 47 and lower. That doesn't mean anything in the greater scheme of things. It just means that the market might be slightly ahead of itself and it needs to fill these gaps. If we look at what happened last week, we can see that, we just are not being able to break through these levels and continue down. Why? Because the data, although it's coming out on the inflation side slightly weaker than expectations, and the real economy is performing maybe slightly weaker, you have a slew of Fed speakers, the most important of which was Waller on Friday, basically telling you that the Fed is going to continue hiking here, and at least 25 basis points more to the terminal rate. So we are definitely, after Waller's speech on Friday, expecting another rate hike at the next FOMC, which is the 2nd and 3rd of May. And since that is what we are expecting, and we really don't have any more very significant data to come out before then, because we've had the non-farm payrolls, we've had the CPI, we keep on having unemployment numbers which, although slightly weakening, they are not weakening to an extent which would change the Fed's mind. And therefore, if we've had all the data that is significant and the Fed needs to make up its mind whether to hike another 25 or not, that probably means that for the next couple of weeks until the Fed meeting, the direction of travel is likely to be towards this 75 area. Try to fill this gap up here, and don't forget this gap is the banking crisis. And as the banking crisis, all the numbers that are coming out for the Fed balance sheet, etc., show that that is abating or has abated. And as the bank earnings, which are coming out, show the same, then it is logical to expect the direction of travel to be towards 75 in the 2's 10s. And if we go to the 530s, it's logical to look for it to go to at least this -10 and then slowly over time to this 0 level. But what it's telling you is that longer term, the odds are for a sharp disinversion at some stage. That stage I don't think is going to be the next couple of weeks. And I think it's more likely that we trade to these levels. If ever we see this 11 level, I think that is going to be, in terms of risk reward, a great area to put on long 5s and short 30s. Next week is going to be a very quiet week data-wise. So if we look at each individual tenure, we can actually see where the big inflection yields are going to be. This is the twos, and I think 426 is that level. I really don't think we go further than 426. There is absolutely no reason. That's the level I'm looking for. In fives, I'm looking for this 370 level to cap. You know, can we try and go to 373, 374? Yes, probably. You know, take out whoever is long from there in terms of futures and just sort of stop him out and then come back. But this kind of level, being short beyond this 371, 372, to me makes very little sense. In tens, this kind of area around the 360 is going to be very, very difficult to break through. And in terms of 30s, I think 377 to 380 caps for the time being. As you can see, the volatility of the 30s is by far the lowest, and that is a function of the yield curve. Everything seems to be anchored around the 30-year area and keeps on swinging around it, with the 30 being some kind of a pivot. If we look at the move, it has come down a hell of a lot, and basically it has returned to where it was pre-banking crisis, and I expect the move really to come down to these levels again around 111, where it's going to be very, very sticky, which again tells me that I'm more or less right in my appraisal that we have a little bit further upside in twos and fives in terms of yields, and very little upside probably, or very little volatility in the 10s and 30s, and the yield curve will basically flatten a little bit and then probably will be ready for another steepening move. What is interesting is that exactly what I said last week was likely to happen is happening, i.e. that the German curve is now leading. This is the Schatz, the twos. As you can see, it's much more advanced in its direction and leading than the US twos that I just showed you. The same is true in fives. At some stage, we will probably break this 246 level and trade something like 260, 261, and we will be much more advanced in both the twos and the fives. You see, the tens again are leading, and we're probably going to go to 257. But what we are seeing in both the German and the US curve is a noticeable reduction in the volatility of travel. And also, if we look at the differential of the cross between the German and the US curve, we will see that the twos have some more to do, i.e. that matches with what I've been saying, that the German sector leads and the twos can go most in up in yield in the US until we get to this 95-96 area. And then if we look at the fives, you can see that we can go another 20 basis points down towards this level. But the tens have reached already this 105 area, and I think they're going to be stable between 105 and 115, that kind of thing, over the course of the next couple of weeks, which tells me that the tens are going to move least, both in Germany and in the US, and are going to be more or less anchored. The bit where Germany is going to lead is going to be in the twos and fives, and lead the twos and the fives in the US. So most of the upwardness in yield will be available in the twos and fives in the US, but it's going to be quite sticky because Germany will go more, and That tells me that the US, in absolute yield terms, next week will move very, very little throughout the yield curve, and most of the movement will continue to be in Germany, especially at the short end, which basically means there's pressure at the short end in the US as well, not as much as in Germany. But what that means is that the curve will try to flatten some more even in the US. What would that imply in terms of FX? Well, I think that would imply that the pressure stays on the dollar, but it's limited because as I showed you, the differential that the interest rates can go is, 10, 15 basis points. That is really not enough to sustain large and continuing pressure on the dollar. I would have thought, as you can see what happened last week, we're trading within these weekly Bollinger Bands and the daily Bollinger Bands. And really the levels are, holding. I would have thought anything between 139 and 99.80 is going to hold the dollar next week very well. And those are probably levels that you are looking for a counter trend move. If we change that to the euro, you can see this 106.40 level capped it beautifully. Can we get to this kind of level? What would that be? That's 111.40, i.e. stop everybody out and go another 50 basis, 50 ticks, something like that. Absolutely. But I think that you are really on fumes now. So anything in the 111.50 area, I am basically looking to buy calls on the dollar. In gold, the 2045 level held on a closing basis for the week. I think that we're getting toppy in gold. I think we're much more likely to trade down to this 1959 area rather than bust 2045 and keep on going north. If you think that, if the market is correct in lowering term premia, i.e. Basically saying that there is a lack of duration out there and it's better to buy tens at this yield rather than keep on rolling whatever very short end paper, and that you're likely to make more money that way, then gold is really not all that attractive at these levels. It could become more attractive later on, but I think that gold has probably got ahead of itself and that it could easily come back to this 1958 area, this kind of level before, doing something like this area here and allowing these moving averages, the weekly ones, to turn. And the daily ones. I mean, we're turning the 200-day, but I think we have time. I don't think there is any rush to buy at these levels. I think lower down, even down towards 1881, is likely to be seen at some stage again, and then probably that becomes a good buy. I'm just not in a hurry to buy gold. I don't see any immediate reason to do so at these levels. I think lowering your exposure at 2045 is, if you are very long of it, makes far more sense than adding. DBC continues to frustrate, and it's probably one of those that you want to leave alone for the time being and let it give you better clues. Very little chance, I think, that we spike at the moment, this 25.40 level, whatever that have, 25.50 level. Because oil, which is its main component, still stubbornly refuses to break the steeply descending 200-day moving average. I think, it's probably likely to do that just to stop some people out and go and trade towards this kind of level, which is 85.50. And this is another reason why I think it's very unlikely that bonds do significantly better next week. I think it's more likely that they do worse, because that will sort of reignite some inflation, hawks talking about, inflation's going to be sticky because oil price is going up. I don't think that any move to these levels is going to be sustained. I think it's going to trade in a range, and at some stage it will even come and try and stop everybody out who is long from this 79.40 area. So I think it's two-way trading. Is it likely to go and trade 85.30 next week? Probably. But I am just not a huge buyer of it at the moment. I think the situation is just too uncertain to start committing very much towards oil or to DBC. If we go back and have a look at how it's trading against gold, I do still prefer DBC, and I think the likelihood is that we come and trade towards this 736 area, and then for some time, and then we will be ready to potentially do a breakout. So for the time being, I prefer DBC to gold slightly. Not a huge amount in it. I'm not wedded to that kind of positioning, which tells me that I should be reducing my gold positions, but I just couldn't be bothered. I think in relative terms, it's not going to go down too much. But I'm probably looking to add some at this kind of level, this 736 level. I think that's going to be important, and I'm looking to basically add gold when we get down to this 736 level, which hopefully is going to match up with that 1880 level in gold. Equity is always important to remind ourselves where we are relative to the Blue Angels. Well, we are higher than the times 18, which is flatlining basically, and these earnings that we are getting from this week basically, because Friday we had the banks, the start of the big banks. I never expected the big banks to be in trouble with their earnings, and I'm not surprised that XLF rallied a little bit on relief, not surprised in the slightest. But now we start getting the rest of the earnings, and we will see how well the economy is doing. And I repeat, it's not Q1 that's important, because we know what Q1 was. I mean, all the data for Q1 is out. We don't have many surprises. We won't have any surprises, rather, from the earnings. The surprises could come in how the individual companies see the future and what they tell you about what kind of demand they're seeing and what is happening to their supply chains, etc. So it's how they lead you that's going to be important. The earnings themselves, I'm not concerned about. I think they will come within a whisker of what the market expects, either up or down, which makes no significant difference. But given what I've been telling you about risk premium, and given where we are, what I'm saying is that the likelihood of volatility next week or the week after is actually very low. And that is why the VIX is down at 17 odd, because the likelihood of volatility is low. If people are buying duration, and equities are by definition the longest duration assets, you are going to find it very difficult to see very large moves in equities unless something happens. What is the likelihood that something happens next week with Zippo data coming out? Well, fairly low. And therefore, that is why the VIX is fairly low. I've enlarged this monthly chart of the S&Ps. I think this 1881 level is very, very important in SPX. Now, can it spike it by a little bit? Of course it can, because as we will see, there are some gaps up at 42, 20, 30 area. But I think it's going to be very, very important whether we close below or above there this month. As you can see, we're trying to do better, and we could continue to do better for 3 months. But I don't think that these levels are immediately sustainable. If we have a look at my clean chart, we can see that we do have this gap here up to 42.32, and actually we have another gap to a close around here, around the 42.70 area. So is it possible that we spike to the upside? Yes, it is, but I think that it's unlikely to last. If we have a look at this chart here, which basically says that things are overbought above 111.65. It's more like, if we do get these spikes, and I think it's more likely that we do than not, because you're bound to have some nice surprise in the earnings and everybody gets bullsed up and starts buying like crazy. And still the volatility is in a massive downtrend, making new lows. That to me indicates that at some stage we get these spikes, and that is why I'm in absolutely no hurry to buy puts, because both volatility is falling and the market is not going down, and there is more chance of it going up. So I want to time it very well for the longer term, and I'm not worried if I can always trade the delta against it on the upside. So I'm really not worried about having to buy puts immediately. I think anything above this 41.80 level that I showed you earlier, if it goes 50, 60 ticks through it, who cares? At some stage, I think we come back and we trade at least this 39-34 area again, without too much doubt. I think the bonds are still in a bonds against equities are still very much in a range. I don't think they'll be breaking out anytime soon, and therefore I think it's much more likely that, having spiked these levels, filled all the gaps, we come back and close below 41.81 at the end of this month, and then trade, below 4,000. Easiest done through options, no hurry, while volatility is doing what it's doing, while the term premium keeps on going down. That puts upward pressure on long duration assets like equities. Absolutely no rush, as far as I can see, to do anything on the downside. And if you looked at how NQ traded last week, well, every dip was bought, right? Why is that? Well, it's the longest duration asset of them all, really. So what can we be looking for? Very, very quiet week. I think we are still looking for it to fill these gaps up here, as you can see all these gaps here. And the real test of NQ will be up here at 13,700. That will be the real test, I think. At some stage we spike and we fill all these gaps, and that will probably coincide with a really good area to start buying puts. None of the foreign markets like the Nikkei or the stocks or the DAX are seeing any pressure at all. Why rush to short these markets is beyond me. I think next week we will trade this 28,800 area on the weekly, after which risk reward is not good. And if we have a look at something like the stocks, you can see, the odds of us not trading 43.66 and higher and stopping everybody out at these, what they consider all-time highs, but are actually nowhere near all-time highs, because the all-time highs were well, roughly 2000, year 2000, that is. So, I think we're bound to trade this 43.66, stop everybody out, go up to 4400, 44.20, 30, 40, and then, as people get long up here, the odds of a reversal will increase. But I think for next week, still absolutely no reason to sell the market now. It's not giving you any technical reason to do anything but buy it on a dip. You can see how VIX finished on Friday, basically the lowest close we've had in 2023. And really since the beginning of 2022 or end of 2021, indicating exactly what I've been telling you, that people need equities, they need duration, and therefore they're buying the longer end of the curves, and they're buying equities. What does that imply? That implies that VIX can probably trade all the way down to 15 at some stage. So volatility is not a buy. But hopefully, and this ties in with what I've been saying about these gap fills up above 4200, we get up to those levels, probably not next week, but say the week after, with volatility down in the 16s or 15s, and that makes for a wonderful setup for a reversal back down towards that 18 times Blue Angel, which is not very far away from 4,000. So you're still looking for a range, you're still looking for the market to spike at some stage and enable you to put on a put position for it to return to more sensible valuations. As you can see, I'm not in a real hurry to do anything, but I would like to basically sell these resistance yields. I buy futures when we get to these levels in in the 10s and 30s. I still prefer to be a buyer of 10s and 30s next week rather than 2s and 5s. I think they are more likely to suffer with the immediacy of the negative carry and the speculation that the Fed will hike by 25 at its May meeting. Everything else, I think we are likely to go higher and trade this 41.81 area in the SPX, and probably then after a pause even higher than that, and fill those gaps that I showed you. There is very, very little pressure, and therefore I don't see any reason to immediately go out and short these levels. I think we will see better levels to short, and in the meantime you buy the dip and you trade it long on the equity side. Here I've included some term premium definitions and studies for you to familiarize yourselves with them and see really how what I've been talking about fits in with the longer term bid of duration. Thank you very much indeed, and tweet you on Monday.